Welcome back, everyone, to the Mortgage Heroes Weekly Podcast Show. I'm Andy.
I'm Will.
And I'm Mortgage Mike.
Mortgage Mike. So we had Lonesome Mike when he was kind of off in the corner giving his commentary, but now this week we have Mortgage Mike, everybody. He is on full-time now.
Yes, and as you guys can see, we're also missing Brian because he's attending to our newest Mortgage Hero.
That's right.
Zael. He's only couple weeks.
Yeah, that's right.
Jeez.
Yeah, so congratulations to Brian and Michelle on the newest addition to their family. We are going to carry the show today, guys, in the absence of Brian. Brian, make all the wonderful comments in the comment box today.
Please.
Let's go. So, guys, at the top, NBA, NAR, NAHB calling the Fed to provide market certainty about its rate path. The Fed officials see restrictive policy staying in place until inflation eases, their minutes show. Consumers point to mortgage rates, not home prices, as the key barriers to affordability. And then we have to talk about market solutions for people that do exist despite all these headwinds that we're facing. So let's jump right on in. First article today, guys, we got NBA, NAR, NAHB, that's National Association of Home Builders, calling the Fed to provide market certainty about its rate path.
Yeah. These are the three largest entities out there, association representing realtors, lenders, and home builders.
Mm-hmm. Well, here's the thing. The backstory here for everyone who is new to this either topic or new to this show is that the National Association of Realtors, the Mortgage Bankers Association, and the National Association of Home Builders collectively represent what they call shelter space, right? Including like renting and that kind of thing. Yeah. You know, shelter costs account for more than 50% of inflation that's measured. And then when the economists and the Fed have to strip out food, energy, and shelter from their inflation numbers, it gives a very skewed perspective on what we're actually dealing with as consumers because it's removing the biggest part of what contributes towards inflation measurement. So these three groups coming together to make this kind of front-facing public statement is a big deal. I don't want to overlook how big of a deal this is because they are also then saying that the headwinds facing the market and facing the consumers are not only tangible, but they're worrisome.
Yeah, absolutely.
But Andy, even though these are like the three biggest organizations coming forward and making this statement, you mentioned a couple of things like food, housing, and shelter that the Fed's taking into account. I mean, the Fed just can't just not raise rates if they need to, right?
Well, it's a function. There's things that the Fed can control and things the Fed cannot. Mm-hmm. So there's things where when they increase the Fed funds rate, it directly impacts certain things, right? Credit cards, car loans, that kind of thing. Variable rates that are tied to the Fed funds rate and prime rate. But then there's things that are indirectly affected. Their monetary policy and their position and their stance changes the way people will trade in certain markets, like the mortgage-backed security market, 10-year yields, that kind of thing. I think the general consensus here is that the market uncertainty is what they're really concerned about, and the market uncertainty is bleeding into all levels of actual real estate professions, but even into the consumer side, way more than maybe intended at the beginning.
Absolutely. I mean, they're calling on the Fed, like, please let us know what you guys are really going to do out there. Because it seems like there's just so much uncertainty out there where we just got to give a break to the consumer, right? We got to give a break to everything that's going on and say, like, please tell us where we're at, where we're going to be at. Just give us something up front. Be transparent with us.
Yeah, and I think on the surface, you go, okay, that's three agencies. They are like the three of the largest agencies, or I just say groups that are associations connected with real estate. And I mean, to come out and kind of plead in this fashion really does represent what we are seeing on the front lines of this. And when it comes to real estate, I mean, you have lack of inventory, interest rates, fixed rates, the highest that they've been in, over 2 decades, since the early 2000s. We've made reference to that. You have affordability being crunched. You have rents that are staying high, stubbornly high. So there's more things that are working against the first-time home buyer than there are working for the first-time home buyer.
Yeah. I mean, these are powerful entities out here,
and that's going to show.
Very influential.
Well, their whole thing is like we want to try to, like, administratively, they want to see more people become home buyers and homeowners, and that's why every once in a while we talk about the percentage of home ownership, and you notice how that's like not being talked about right now. They're not talking about it because it's going lower and lower, and more people are becoming renters because they have to be.
Yeah, exactly. As a result, a number of people who can afford to buy a home has definitely declined.
Yeah.
Well, then what do you think they're going to think when they see that policymakers they want to have one more hike by the end of the year. What do you think they're going to think about that?
Less affordability.
Less affordability. Well, I mean,
Ding.
but they have to. I mean, again, they're kind of like, it's, that saying, guys, like you have to make the bed or sleep in the bed you make.
Yeah.
Or you make the bed you sleep in.
Yeah.
Whatever. However that term goes.
Make your bed.
The point is they're going to have to deal with the consequences of their decision. This whole thing about we got to get back to 2% inflation is honestly, from Andy's seat, a pipe dream. Yeah. It is 100% a pipe dream. Now, I was not an advocate that they should adjust their number upwards, their target upwards to 3 or 3.5. But honestly, it's probably going to have to only become that unless there's like a complete catastrophic bottoming out of everything, because otherwise there's nothing driving inflation back down. Back to your question, Mikey, your point about the Fed and what they influence is like they are not influencing directly oil prices. Yeah. So when crude oil goes up and that just gets passed through, you're starting to see this in things like the PPI, the producer price index, that is once again positive and higher than expected. So those things end up making it to the shelf. You go buy that product that upstream was on a truck, and that truck had to be filled with diesel, and that diesel had to be made and refined like with oil. Those things the Fed's not in control of, but they're fighting against those things all the time because those costs make their way into the pipeline of the system.
Exactly. One of the things they can control is what they're selling off in mortgage-backed security, and that has a huge effect.
That's true.
Right, Andy? So why is it important for the Fed not to sell off our mortgage-backed securities?
Well, so the easiest way to explain it is it's transfer of risk. So if you're going to have something on your profit and loss or your personal budget or your monthly, and you transfer that off of you and it comes on to me, now I absorb that as the market. And so the market does not need that right now. The Fed did us a favor in 2020, 21, and even a little bit of 22 by buying mortgage-backed securities and aiding in implementing low rates.
Yeah.
But now rolling that off is like confirming, okay, well, these higher rates are going to be elevated for longer, and also we're going to reduce our risk and put that back onto the market.
Yeah. Back in the day, Mikey, to give perspective, they were purchasing, and correct me if I'm wrong, but an average of $80 billion a month.
A month, yeah.
And what are they purchasing now?
Well, nothing. Well, I don't know if it's nothing, but they're not purchasing mortgage-backed securities.
They did like just taper down and say we really can't afford to continue buying. That's why the rates were so low. That's why they were in the twos, back in the day.
It's the equivalent when you were online, you're hearing people say, "Oh, the Fed's just printing money." Yeah. That's their short way of saying this is the equivalent of the Fed printing money. Is they're making it so cheap and they're participating in the mortgage-backed security market, which made this big basket of money available for people to lend out.
Gotcha.
So where there was a lot of money. So when there's a lot of something, it costs a lot less. When there's scarcity of something, it costs more. So by them removing it from their balance sheet, it creates more scarcity of money in the mortgage-backed security market, but also it's a transfer of risk as well.
Yeah, that's why.
So hold both things happening
to those mortgage-backed securities that we have, please.
So, these housing groups are urging Jerome Powell and the Fed to make two clear statements that, number one, the Fed does not contemplate further rate hikes. I don't think he can commit to that. We'll come back to that. Number two, the Fed will not sell off any of its mortgage-backed security holdings until and unless the housing finance market is stabilized and mortgage to treasury spreads have normalized. Again, these are things that they may want their voice to influence, but the Fed keeps coming back to us and telling that it's the data. They're being data driven. It's the data. It's the information that's going to dictate their decisions because they are tasked and charged with price stability, getting inflation back to 2%, maximum unemployment. But there's going to be factors that are not going to be playing well. Nice. They're not going to. Not everyone's playing nice in the sandbox, if you will.
All I'm saying is, Fed, please start reducing the stress, anxiety for us home buyers. Seriously, please.
Yeah. So they're projecting on their dot plot chart. For those of you who've never seen a dot plot chart, it's basically a graph that shows where the Fed members who are projecting where they think the Fed rates are going to be for the rest of this year into 24, 25, 26. And some of them are foreseeing that there is one more rate hike. It depends heavily on inflation numbers and on jobs data. Their words, not mine. So comment box, take it easy. Well, I didn't say it, they did.
In my words, I feel pretty confident, that might happen.
Yeah, if it's not in the November meeting, it'll probably be in December. But again, I'm going to make a point I made a couple shows ago. If you knew it then in September, why didn't you do it then?
Exactly.
So if you knew it in September, why'd you wait till November or December? We're going to have to wait and see. But I think their arm being twisted behind them. They're going to have to do something. Again, if that's their solution for how to fight inflation, they've been doing this now for a year and a half. What are they going to say? Oh, we have a new method now. They don't. Right. They don't have a new method.
Been more than a year and a half. March of 2022.
March 2022.
Crazy.
Yep. So, and so alongside with this, we have the 10-year yield, which is now in this new range of 4.5 to 4.75. Again, for you, those of you who are new to the show, mortgage rates, 10-year yield, they actually track with one another very closely. And the last time we'd seen this rate of the 10-year yields, or this price of 10-year yield, was back in 2007.
Yeah, 2007. Crazy.
So it's been a long time since we've seen that. And it's not just high prices we have with real estate and with all that. It's just the inflated prices that are staying in place, that are now taxing Americans at every level.
I mean, the other thing that's just super crazy, right? Back in the day, the banks for many, many years were borrowing from the Fed at 0%.
That's right.
And
when was that?
Oh my God, that was
0%.
Since the Fed's been at
increased.
zero.
Yeah. It was at zero in March of 2022 when they started increasing the Fed funds rate.
Oh wow!
So in that just short amount of time, it's gone to a historical high never seen before.
Yeah, it's acceleration of going to this rate now, this 5.25, 5.5. This is the fastest it's gotten there in recorded history.
And that's what we're seeing, the rates higher, right? When the Fed is giving you money to loan at zero, well, there's no reason for you to lend it up that high, because it's like most other people, you got to stay competitive within the market range.
Right.
Yeah, otherwise no one's buying from you.
Or borrowing from you, right?
It's simple math. If you can borrow the money at 0% and then you can lend it out at 3%, you're making an arbitrage of 3%.
Yeah.
So same. If you got a 10-year yield or 10-year note at 4.5% and you're charging 7.5%, you're making a 3-year arbitrage, 3%, 3% arbitrage.
Yeah, I see what you're saying.
So when the Fed is like ticking up and up and up and up, that's why all these borrowing costs keep going up. But then that tempers borrowing, because I don't want to borrow at a 10% rate for a car loan.
It's too
I don't want a
expensive.
credit card at 29.99.
Jesus Christ, a 10% car loan would be insane. I remember I went to go apply for a car loan like sometime last year, and they approved me for up to like $35,000, and with my credit the rate was like 4 3/4, so it's still pretty low.
Yeah.
But I mean, sure, if I went back now, I'd be in the 8s or something. I wouldn't even bother to buy a car.
Especially used cars. Cost you more money.
So we'll see what they do. I mean, look, there's no obligation for the Fed or Jerome Powell or anyone to really cave to the NBA, NAR, and NAHB's requests. But I mean, certainly, this hit actually the national news. This wasn't just like us in real estate and mortgage that heard this. Like, this is the pinnacle of association leaders making some waves and at least publicizing their concern. So we're gonna have to keep one eye on that, guys.
Yeah, and even after seeing these 3 most influential associations, pretty much the Fed is already saying they're going to stay strict with the policy. It's going to stay in place until inflation eases.
Well, I mean, if they're truly data driven, like what other choice do they have, really?
Yeah.
That's the point. Yep. Well, let's get into that, guys. We have Fed officials see restrictive policy staying in place until inflation eases. Their minutes show. Now, the minutes always come out a couple weeks after the Federal Reserve makes their public comments and their prepared statement and take their press Q&A. So, Uncle Uncle Jerome Powell, and their meeting minutes were released, and there were some differing opinions. So, again, not everyone's on the same page on what the Fed should do and why. And among the voting members, you had some that say we need to stay where we're at, and some that say we got to do another rate hike.
So I know you said, not everyone's on the same page, but it says about 2/3 of the committee actually do want to have another rate hike by the end of the year. So I mean, that's pretty overwhelming, number of people.
Yep. Yeah, it is. And it's going to take something
and here it is. That's to tell you the rich, their lifestyle is not going to change, right?
Yeah.
So it's easier for them to say certain things when the majority of the people don't have that type of account. So for us, like, we're us 3 in here, we're like, no, reduce the rates, right? Get us in there. Let us have some normalcy once again.
Yeah.
Right. And so these guys really doesn't matter. Their life change, their lifestyle ain't going to change.
Yeah. I mean, I think when they put their hat on for what their professional expectations are and requirements are, they know that, it's kind of like, oh, that's being done on my watch. Right. So I have to make a calculated decision with the information I have. This goes to the data point you're making and asking about. Is that they are data reliant, but again, I have to say, when you are relying so heavily on, let's say, core PPI or core CPI, which strip out things that we actually still pay for, I mean, I'm starting to side eye your intention. I'm honestly like, well, are you being serious or not? Because if I stuff in my fuel costs, I stuff in my housing costs, I stuff back in my food, my eating costs, I actually still pay those things. And so you saying you strip those things out in order to come up with some other core number that helps you make your data-driven decision, that's really hard, because you're just dealing with a significantly reduced set of data in order to make a decision that
There is unanimity at one point that rates would need to stay elevated until policymakers are convinced inflation is heading back to 2%.
Of course.
So I mean, at what point does inflation have to be at where they stop raising the rates?
2%.
2%, or it says are convinced inflation is heading back to 2%. So maybe it'll happen at 4, 5. I don't know.
Well, again, that is the question, right? At what point do we feel like it's going in the right direction? And I'll tell you that, month over month, when inflation stays at monthly over month, it's at 0.5, 0.6, 0.4. That doesn't cumulatively get you back to 2 until a long period of time.
Correct.
You have to get to it being 0, 0.1, 0, 0, 0.1 for it to cumulatively go back towards 2 as a whole, as an annual number.
Yeah.
So it's every month we pick up a new month of data and we drop off the 13th month, right? We pick up a new month, drop off one off, pick up one, drop it off. We have to have successive months like that in order to get back to 2.
I mean, see, it's just like the best analogy I use is throwing a rock into a pond. You throw the rock in there and you know how you see the ripples? It takes time for you to see that ripple effect. So, and there's a lot of things that factor in. The ripple's not always going to look the same, all of them. Some will actually go longer, some are shorter, if you notice that, right?
Yeah.
So there's a lot of economic factors that factor in whether or not we're going to see that ripple effect take place sooner or is just going to be way later. And what we're seeing right now, based on all the data since March of 2022, we've seen inflation not go down as drastic and as fast as we thought it would. Mm-hmm. And that's just a longer ripple. And right now, with everything that's going on in our world, oh my goodness, it just may take longer. Would you agree with that, Andy?
Yeah, and I'm glad you brought that up. And that's a great analogy because there's people that I listen to and I watch and I read about, and their kind of silent concern has been, what about reinflation? Because reinflation is something that we've seen, and again, it's part and parcel from a variable that is not controlled by the Fed. Fuel costs make their way into every single product because companies pass on expenses to consumers.
That's right.
So when fuel costs go back up and instead of $5 a gallon, I'm paying $7 a gallon, the business finds a way to put that into the hands of the consumer at a higher price, which means that price becomes sticky and the Fed can't do anything about it.
Yeah.
So if there's going to be oil scarcity, that makes its way through the pipeline of manufacturing into goods, not as much into services, but as a service company, guess what?
Yeah.
I have expenses and everything I'm buying for that's at the tail end of this pipeline is more expensive. So now I got to charge more as a service as well.
So you're not going to be a nice guy and just take the hit. You're going to pass it on to the consumer is what you're saying.
I don't even know that it's being a nice guy or a bad guy. It's about being mathematically practical.
Andy. Charge less for gas.
Charge less. Well, and then when you start talking about, how do companies, how do they avoid that? They start cutting people.
Correct.
They cut expenses and they cut people. They can cut back on some benefits in some cases, which again, those then make ripple effect material impacts in your labor force.
And that's the biggest commonality. When things are changing in the market, the best thing you got to do is start trimming some of that fat, right?
Yeah.
Yep.
Otherwise, you're not going to survive that next through the season. Mm-hmm. You'll be kind of like just going out in the rain without an umbrella.
Yeah.
And so what you want to do is you want to take extra precautions and make sure that you're trimming some of the fat so that you're able to sustain through that and weather that storm. Yeah,
and I think even in this article, they're concerned about the inflation being sticky and that there's like an upside risk to prices.
Yeah.
It's legitimate. I mean, I see it when I'm doing Monday Mortgage Minute and I'm looking at all the data to communicate to people what they need to be looking for and what's happening, what's changing. Along with the need, I'm going to say the need for them to see more unemployment. These are just facts of the case. They've set the stage on the chessboard for them to need more unemployment to curb spending, and curbing spending will help curb prices, so on and so forth.
Did that answer your question, Mike?
Yeah, or they could just open up that one oil pipeline they closed a year ago.
Oh, jeez. That's really funny.
Wishful thinking.
Yeah. I think Mikey just wants, you know why? Mikey just wants cheaper gas so he can drive quicker.
Yeah.
I think that's what it is. He's got a 2-door car now.
No,
so
I
it's
just don't want to, drive home in silence after filling up gas every time anymore.
Yeah, it's okay. You could walk home.
That's it. That's it.
All right, guys. Consumers point to mortgage rates, not home prices, as the key barrier to affordability. The finger's being pointed right at us, guys. It's not the home price that's the problem. It is the mortgage rates. Right out the gate, that tells me that people see the value in the current price, but they do not they do have an appetite for the amount of monthly cost they have to carry to get it.
Well,
Absolutely.
As a loan officer, I see that and I kind of just think, well, duh. I mean, the interest rate is what's going to raise your monthly payment or lower. I mean, remember that one client we saw where I think we priced it out and it was about 7.25 or maybe 6 3/4. And then we priced it out at 3.5 and it dropped almost half of the monthly payment.
Yeah.
So it's like, when I see this, it's like, well, obviously.
Well, the craziest thing that I saw was compared to last year right now, right? If we're talking about somebody's mortgage, it has gone up from 60 to 74% more.
Yeah.
In just a year's time, which is crazy because that proves that point that we were discussing, right? When we're going over there and working with your 3.5, 2.875 versus now where we're at in the 7.5. And we're getting closer conventional, some at 8%, which is pretty crazy.
I mean, even you say it was like 60 to 74%, which is obviously ridiculous. But imagine I went to you guys. I said, hey, I'm going to raise your mortgage payment just 20%. You'd be like, what the?
Yeah, 20. So it's already
No,
Just kidding.
No,
It's
that's
74.
not too bad. But you're absolutely right. People are more concerned about the interest rate. 1%, what they're saying is a 1% interest rate higher than before is going to make my payment hundreds of dollars more a month.
Yeah.
Versus, I can purchase 800,000. I'll buy it for 850. If the rate was lower, I think they'd be more prone to pull the trigger on something like that.
Yeah, this is a little bit of like a little teeter-totter exercise. One thing goes up, the other thing goes down. And so when prices were going up and rates were at 2.5%, 3%, 3.5%, it's like, oh yeah, sure, I'll pay that 850. Oh, it's not 800, it's 850. Well, it's only going to cost me an extra $60 a month or $80 a month. But now you're talking about that 800,000 at like 7%. Oh, now I'm talking about 180, $230 a month different. That's a whole different ball game. And then you have an affordability crunch on that too. But what's interesting to me about this particular article is it is sentiment. Once again, we have this conversation. Well, why does sentiment matter? Well, it certainly does, because sentiment impacts decision making. And in September, 16% of consumers reported that it was a good time to buy a home. 16%. That's 16%. 16%.
Yeah.
And then you have 84% indicating that it's a bad time to buy a home.
Wow.
This is really a dent. This is a massive dent to the percentage of home ownership that like every administration really cares about, and increasing home ownership, especially among first-time home buyers and in communities that maybe don't have a high rate of home ownership. This is going to be a problem. I would be very surprised if this was overlooked in the election cycle coming up in 2024. I think this is going to be something that people talk about.
Well, on a good note for all you listing agents, realtors, right? 63% said it was a good time to sell.
Yes.
Yeah. That is down 3% from last month, though.
Yeah.
But hey, 63% of people are trying to say, hey, it's okay that I have a low interest rate. I think it's a good time to sell. I'm thinking, they think, well, this is the peak of the market. This is a good time to go out there and sell my property.
Yeah, and another, I feel like another reason why people are saying it's not a good time to buy too is because it says here, 23% of people think they're going to lose their job in the next 12 months.
Yeah.
That's a pretty big number.
Yeah, that's a psychological like ball and chain, if you will. Like it's already like running ahead of you that, this might be a problem in my life. And again, I'm not saying that's without just cause. Maybe there's something in your work environment where you can kind of see where things are going, and maybe there's legitimate concern for that. But that is all problem because that spills over into other consumer buying behavior.
Well, and it's a valid problem just because, especially how you mentioned, if fuel costs are going up, the company has to put that on someone, and they might cut cost in the way of employees.
Absolutely. And here it is, guys. We're not just talking about fuel costs. That was just one of the factors.
One variable.
If you really look at even your food from even a year, I'm going to say even more than a year ago, it's gone up like 20, 30%.
Yeah.
When we're saying, inflation was at 6%. It was really more like 24%. Because when we were looking at purchasing even a bag of popcorn, my mother-in-law likes to make, caramel popcorn. And she was seeing how the bags were downsized. She used to buy these big old bags, and now they were downsized like about 20%. So if you really look at all those things, it's factoring into the food. It's factoring into your electricity, utility bills. People, what was interesting, I heard that in the last year, more people have actually gotten into a second job just to pay for their utilities.
That's right.
So you're seeing more people working at your Starbucks, your Walmarts, your stuff like that. And in the jobless claims, it looks like, there's less. There's actually more jobs being produced because these people are holding 2 jobs, the majority.
Right. And they're counted as another employee. That's important to note here. And this goes back to Uncle Andy's complaints about data and what the decisions the Fed's making based on data. Let's say you go out and get a second job. That counts as another job that's filled, not a person with a second job. It's like a second person. But you're not a second person. You're still the same person now with 2 jobs. So it looks like we have more employees, but we don't. We have more jobs filled, but it's the same person holding 2 jobs or maybe even a third.
And then what's the best thing? Unemployment. It doesn't count if you're accepting unemployment checks. You're not considered to be unemployed.
You can be unemployed but not receiving unemployment benefits. And then after unemployment benefits are over and they've expired, you may still be unemployed but not counted. So the idea of unemployment is a very defined, specific set of criteria that does not include the entire story. So that, again, leans into, people the price is clearly not an issue. It's affordability. It's mortgage rates. People do not have an appetite for this at large. But again, I know we're going to end up talking about solutions in a minute because, we still live in a country and in a city where people want to own their house. They want to have a place for their family. They want to have a place for themselves. Maybe they have another generation of family that moves in with them right now temporarily or maybe permanently to make that work and make it affordable for everyone collectively. But I still think that there is that drive and that desire for people to acquire home ownership, and that doesn't care about any of this stuff we're talking about right now. If someone wants it, they're going to go do it.
Funny you bring that up. On a couple of my properties, I already have my previous tenants asking if another family could go in there. So guess what I have to do? Run a new application. There's going to be wear and tear in the property. But what can I tell to that tenant that can no longer afford the rent increase that I have to do? It's like I have to keep up with everything else because my expenses also go up. So, even though I consider myself a good landlord, right, very generous, and, I do that. And of course, I'm going to consider that only because I understand the kind of position we're all in. So we're seeing more of that. We're starting to see more people going and asking, hey, can I bring another family in? Because that's the only way they'll be able to afford is by they're kind of consolidating themselves.
And there's we're starting to see kind of like this separation between people who are psychologically removed from the process because they're not able to compartmentalize that versus mathematically affordability wise just eliminated because I don't make $6,000 a month or I can't make a $6,000 a month payment with mortgage or a mortgage payment, principal and interest, taxes, HOA, and all that stuff. So there's the mathematically eliminated, and there's the psychological people that just punch out.
Well, yeah, and it doesn't help when a lot of new homeowners who are looking at getting homes are a younger generation. So you probably have your parents, uncles, family members. Oh well, I only paid $400,000 for this house. My mortgage payment's less than $2,000. You're crazy for buying right now. So I'm sure that doesn't help either.
Sure.
Oh yeah, exactly.
It's just another. It's another weight on the scale. Like it just.
I mean, people take it into account. They do.
It's so true.
Yeah.
It's almost like I don't know. How can I say this? It's like $2,000 to hear those payments. That's like is that going to be history? Is a new norm going to be, nationwide, it's $2,900 nationwide. That's the average mortgage payment nationwide.
That would be fantastic here.
Right? Come on now.
It's terrible in some other places. That's really high.
Our new norm is going to be at least $4,500. Like, oh my goodness. Yeah. This is just, I mean, we saw a friend at Starbucks this morning. And what did she say? I was considering selling my house that I've lived there for the last 14, 15 years. But then when I go and I look at a condo and I'm going to pay $4,000, I'm like, I'm not so bad where I'm at.
It's like a two-bedroom place.
It's the golden handcuffs that Brian always talks about.
Jeez.
100%.
Like where can you go? It just doesn't make sense.
Yeah. So conditions for consumers are eventually going to have to come around.
Yeah.
I think the question mark for me, guys, the wild card really is honestly just when.
Yeah.
It's when. And always coming into an election year, I get a little bit more skeptical only because a lot of jockeying happens during that year where we know everyone's going to be casting ballots in November. And we're right around that time. We're only 13 months away from that. That sounds like a long time, but it's really short.
It sounds like a long time.
Yeah, the election is closer than when the Fed first started raising rates. How about that? The Fed did that 19 months ago. The Fed started raising rates 19 months ago. Elections in 13 months. But I guess my skepticism is this: that the conditions that are going to make things better for consumers are only going to come by a force function of maybe a handful of things. Number one, something catastrophic that requires the Fed to just go right back to zero right away, which I don't want to see because that would mean much more pain. Or a set of conditions that data driven, they actually get honest with people and honest with themselves, that gets us there quicker, or they let it ride and it's going to be slow through 2024 on the pain pain meter, and people who have like their grit about themselves are be the ones that are going to get in that inventory even if the inventory is low.
Yeah. Hey, the good thing is, and a good note is, equity is at an all-time historical high.
Yes,
nationwide,
and it's staying that way.
So you have solutions, right? Which leads us to our next topic. It's just
thank you.
Yeah, exactly. It's not all doom and gloom here. You know what I mean? The good thing is we have options. All right, so. We're going into some of the market solutions. What do we do in these certain situations where times are difficult? How do we leverage?
I got one.
Yeah. All right, Mikey, drum roll. Let's go.
All right. So we talked about a couple things today. You just mentioned equity is at an all-time high.
Yes.
We mentioned, people might be losing their jobs. And then this article also mentioned that, probably because of a multitude of reasons, people are going to start relying more on credit. Yeah. So if that sounds like you're relying more on credit and you have equity in your home, tap into it. Yeah. Cash out refi, pay off that credit balance, roll it into the mortgage.
Yeah.
So the first question someone asked is, I'm going to have to do a cash out refinance at like 7%. Yes, the answer is yes. Yeah. You know why the answer is yes? Because your credit card rate's 30, or it's 20,
that's what
or it's 15, or whatever. Yeah. So it's still going to be cheaper in the end, even if it doesn't seem cheaper right now. And it creates a convert sum that's non-tax deductible into something that is.
Yeah. And let's go with history too. Another historical fact is consumer debt it's at its all-time high. It's over $1 trillion, right?
Wow.
So that is the highest we've ever seen. So obviously we need to find a solution for those for a lot of people. Maybe right now it seems good because, again, there's plenty of jobs. We're working 2 jobs, but you get tired working 2 jobs. Would you agree? Especially,
I've never worked 40 hours a week.
There have been a number of situations in the past where, we've talked with people and maybe they made some consumer purchases that they, let's say, privately would regret: a motorhome, a boat, a third car, or something like that. But then, you know what? The house also gained in equity at the time. Let's let the house do the work. Yeah. So my RV payment is $1,500 over here. But if I pay my RV off and I have it as part of my new mortgage as either a HELOC, a second loan, or a cash out, maybe my monthly out of pocket only goes up by $700, but motorhome's paid off. So that's an arbitrage of $800 in net gain, or net savings, I should say. Yeah. So you get to keep it, or you could just sell it and not have it anymore. That's fine too.
Yeah. What a bad example of working 2 jobs asking Mikey that, huh? Some of the solutions of how you can actually tap into your home equity is you get what's called a line of credit, or a second lien on your property, which is a HELOC, which stands for a home equity line of credit, or a HE loan, a home equity loan. Mm-hmm. And there is some differences. A HELOC is going to be like an open end, similar to a credit card, right? And the great thing about having something like that is there's pros and cons to both. Okay. So on a HELOC, what will happen is when you borrow against what you draw. So let's say you get approved and it's $150,000. The cool thing is if you only draw $50,000 of that, you're making payments on that $50,000.
Got it.
Okay. Whereas with the HE loan, when you draw the $150, you're drawing the whole $150 and you're making payments on that $150.
So with the HE loan, it has to be a lump sum.
That's correct.
Okay.
Then the other difference is, with the HELOC, it's similar like a credit card. The interest rate, how sometimes right now the Fed is increasing that rate.
Yeah.
Well, you already know you're going to pay a little more for that. right? Whereas a HELOC, it's got a fixed payment.
Now, here's something that maybe a silver lining that kind of might go past some people is that if the Fed is going to be done right now or going to be done soon, then you would be getting a line of credit maybe at the perceivable top. And then when rate cuts do kick in and happen, then the debt servicing of that would be less and
That's
lower.
a great point, Andy. That, you know what, I didn't even think about, but you bring a great point.
So, how would someone know which one to choose, though?
It all just depends on what you're comfortable with, right? And obviously, when you're providing your documentation and we see your financial situation, whoever you're using, they have to look at those things, and you'll have to consider what your affordability is at that point in time.
I know you mentioned the rate with the HELOC, it kind of changed like a credit card. What about with the HELOC? Is that just fixed?
Typically fixed rate, correct. It's typically a fixed rate. And the great thing about it, what most people don't understand, is when you use these things, if you're using them for like you can use them, a HELOC or a HELOC, you can use it for anything. You can use it to purchase another investment property. You can use it to do renovations in your home, do debt consolidation. And here's a great thing about those, right? People think, well, I have a 2.875, but why do I want to get a 12 or 13%, interest rate on that? When you're getting those funds, if you blend the rate, you're probably going to be at like a 6.5, versus a credit card where you're more like at 24, 16.
Yeah. Something outrageous.
It's proportionate rate cost.
Exactly.
So you may have a $500,000 loan at 3%.
Yeah.
And then you have a $150,000 HELOC that's at, let's just say, 12 or 10, then the combination of them being different balances and at different rates are blended together, and it's actually cumulatively a lot lower than you might think.
Correct.
Yeah.
And the other benefit of it, if you use it for home renovations, the interest will become a tax write-off for you. But you'll have to talk to a CPA, okay? You'll have to talk to them. But where credit card debt is, they're not. You could be paying into that as many years or whatever. You'll never make it a write-off. Yeah. So it's got a lot of pros and cons to it. The only con is, the rates are higher, and it is what it is. The cool thing is, like you mentioned, Andy, the rate, as we know, the Fed's already saying it may just be, another 0.25% rate hike. And then it's probably going to be the peak before we start seeing, rates
actually,
come down.
Let me challenge you with this.
Okay, perfect.
So with I'm kind of thinking right now, why wouldn't someone just do a cash out refi on the first position instead of doing a HELOC and being in second position? I get it, the HELOC is fixed, but I'm assuming, the rate's going to be higher opposed to just doing a cash out refi.
It
on the
may
first
be,
mortgage.
and it may not be. This is why you got to this is why people need to talk to you or to Will or to Brian, is because it may not be, because one will win out. One will be cheaper. The blended rate of doing the HELOC or HELOC in addition to your first you have, and or doing the cash out. Maybe you do a cash out at 7.5%. Yeah. Okay, great. But if your blended rate is 6.5, instead of 7.5, it's 6.5. Then it's actually better to do the HELOC.
Okay, I see.
Does that make sense?
Yeah, I see what you're saying.
Because again, there's a way to factor it, because let's do a real extreme example. Let's say you have a $900,000 first, and only a $100,000 second.
Okay.
Well, if you do $1 million cash out at 7.5, that may be exorbitant compared to a $100,000 loan that's at 12, but your $900,000 is at 3%. It might only be 4.5 or 5. You see what I'm saying?
Yeah.
So it's scenario by scenario.
And the other way to think about it too is let's just say you even owe 700 or 900,000, right? We're not going to refinance the first. What maybe a lot of people want to just say is, I just need 50,000. Brian just did one for 55,000. In that case, even if it's a $400,000 or $500,000 loan, it doesn't make sense to actually refinance everything for a $50,000. Right? Because when you pay off that $50,000 debt, it may be only, $700, $800, where we're going to increase the payment by $2,000. Remember earlier we talked about people's mortgage payments has increased by 60 to 74%.
Yeah.
Well, that would be the typical factor in this situation.
Yeah.
Wow, you guys handled my challenge really well.
Yeah, fast.
He said the word challenge, but I didn't feel challenged.
Yeah.
No, so there's a line in the sand, right? There's a mathematical line where people go, oh, it makes sense to do it this way versus that way. And then I'm going to put this on the table too, because I know I drive around town, I see it happening. I see garage conversions happening. I see ADU second story builds on first story homes that are approved, or a house in the back with a separate drive. They're still happening. So Despite other shows where we've talked about labor costs being high for builders and material costs still remaining elevated, some have reduced, the shortage of people to find. Look, homeowners who have the permittability and the equity are using that equity to invest in the long-term future of the house.
Yeah, actually, I have a buddy of mine. I'm going to shout out Greenwich Construction. Shout out my boy Cliff. But yeah, they just got done building a 2-unit AD or something like that. It was a 2-story, somewhere around here. So I mean, it's still happening, and they're staying busy. They're doing these projects quite often.
Well, the cool thing about it is we just did an $85,000 line of credit, and the payment was $950, right? And they needed only $75,000 to convert their garage into a 1-bedroom, and that's here actually in Sumbo in Eastlake. Well, not Eastlake, but Chula Vista, Sumbo. Yeah, and they're renting out that place for $2,100.
Oh, right? Wow.
So
so it's costing them $950 and they're renting it for $2,100. So they're cleaning $1,150 a month.
Exactly.
That's great.
And that's temporary. That's just temporary right now. Those are just funds that are temporary because as in this case, they chose to go with the HELOC, right? And what's cool about it, it's like a credit card. So once they use some of the money to pay it down, they're actually paying down that line of credit and they'll be able to use it multiple times.
Yeah, reuse it.
Yeah.
So that's good. We got people use home equity lines of credit or the HELOC for investing in a down payment to buy another place. I know there's some new programs coming out for multifamily soon, right? I think Fannie Mae just announced there's like is it 5% down?
Yeah, 5% for multi-units up to 40 units, which is phenomenal. Yeah. That's going to be another great thing. So if we're looking, hey, you know what? I'm looking to become somewhat of an investor, and this is my first time buying a home, and I only have 5%. Typically before it was 25, 20% down, and FHA could have been 10, 15% down, and you still have that mortgage insurance, right? So now it's going to be 5% down. That is huge. That is going to be a huge, and the reason for that is because, again, you're going to qualify for what you could afford, and if you're buying a 3-unit property and you're going to occupy one, you can use the rents from the other 2 units to help you qualify. Yeah. And it's going to be based on market rents. An appraiser will go out to the property. They'll do what's called a rental survey on that, and they'll see what the market rents, and that's what we'll be able to use to help them qualify for that mortgage.
And this is a really good example of the market coming up with a creative solution for the current set of problems and conditions that we're facing. And we talked about this at the beginning of the year. We're like, you know what? Anytime a crunch happens like this or things change, creativity comes out of this because it's out of necessity. So this is a good example of that. So we have the HELOC and HELOC are good for investing in a down payment on a place, renovation or refreshing your place, updating it, maybe giving it a little bit of facelift or taking care of deferred maintenance. I know people don't want to talk about that, but there's a lot of deferred maintenance even around our own neighborhoods here. We think, these houses are all still brand new, but then I go, you know what? Wait a minute. This house was built in 2003. Yeah. That's 20 years now. We're starting to come up on stuff like that. Fencing up and redone. We got to get that house roof painted, attended to. Maybe that air conditioning unit isn't sufficient. So we got debt payoff as well. Debt payoff or debt restructuring. We have also then the income portion, adding an ADU or converting your garage.
Yeah, and debt consolidation was the most important. You know, that for me is just a game changer. We just, a lot of people don't even have refinances. We just got done with 3 refinances and it all made sense. They were willing to sacrifice their 2.5%, their 3.25% interest rate to consolidate everything. You know, because that opened up monthly another $2,000 a month after paying everything off.
Yes.
You know, and I mean, you worked on those.
Yeah.
And you saw the difference there.
I want to say something to our audience that I think it bears repeating. I know we've said it in a couple different situations before, but, there is something to be said about coming to us before it's too late.
Exactly.
I understand and I can relate and I can sympathize with people who go, I'm kind of embarrassed by this situation or I'm uncertain what I should do. I don't even want to bring this up because I have to kind of admit that, I kind of made a bad choice over here. But here's the thing. Memo's point is that home equity is at all-time highs and it's remained there and home prices have recovered even after a little bit of a dip. The house can do some of the work. Let the house do some of the leg lifting or the heavy lifting before you are unable to. So if you are feeling like, down the road, maybe I may not be able to make my mortgage payment, while you can, and before you have any late payments, let us help you. Let us figure it out with you and come up with a game plan. It may not even result in you doing a loan, or it might. But the point is, you can come to us privately and have a conversation before it's too late. Don't corner yourself by trying to maybe uphold some sort of a posture that everything's okay, because if it's not, that is exactly the type of situations we're solving for people right now.
Exactly. I just had a client that gave me a call, and she has 2 30-day mortgage lates. Well, guess what? With conventional, you can have within the last 30 days. I mean, 30 days, within the last 12 months. Right? And then FHAs works the same thing. VA is the only one that's a lot more aggressive. And that's going to be like, it all depends on the AUS if it takes it or not.
Yeah. And I'll be fully transparent here for the consumer. They have nothing to be embarrassed about, because this is literally our job, is to get deals done.
That's right.
Like, we want to help you. Like, we want to do deals. So let us help you.
Yeah. And, I also know, and I mentioned before, I have a very good friend of mine who's a bankruptcy attorney. And, on one hand, there's a case to be made that bankruptcy could become rampant in the next couple of years.
Yeah.
The other side of that, his whole point is, but that may not be the case for homeowners. He's like, for homeowners, the bankruptcy court even will say, then take money from your house to pay off these debtors to make them whole. You can't just hold on to everything you own and you get to gain from it while also holding everyone else at bay financially. So even his point is not even in our industry saying, BKs might not be as crazy for me, because guess what? People are sitting on tons of equity.
Can't have your cake and eat it there, huh, Andy?
No. Well, and here's the interesting thing, like, that you might be getting pinched on one side of your life, but you don't have to. So it might be a case of having your cake and eating it too. You're right.
Here's the thing: we get emotionally attached to a lot of these things, and it's material. When I bought my first home, I didn't buy it because there was equity. This was back in 2000. Actually, the market was barely recovering from that 1998 situation, that we were going through. So we're kind of recovering, but I bought it just because I wanted to own a home. And then what happened? I saw 2005-06, that home that I bought for $242. In 2004, I saw it. I sold it for $675. So I was like, no way. That's when I go into downtown Petco Park, and I bought a couple condos over there. I bought another bigger home. And then I was just getting spoiled, right? Yep. And then I saw that there's money to be made in that. And that's why I did it. But we gotta not get emotionally attached to things. Luckily, we're in a city where equity went up as it did, and we can leverage that situation. So all it is here is leverage. Don't put yourself in a bad situation where it's not needed, because then when you don't have a job and you made a mortgage late payment, guess what, Mikey?
What?
Don't qualify.
That's right. Yep. Can't do it. Yep. So come get help. Come get your help while you can. We're obviously going to treat you fairly, but obviously, also call a spade a spade. Where you can get help, we're going to tell you. Where you can't get help, we're going to tell you. It's to your advantage, not to ours. Mm-hmm. So, what was your favorite part of the show today, Mikey?
Wow. I mean, we ran through a lot of scenarios. I mean, I don't know how long this show is, but it was a good one. I just think we killed it today.
Okay. How about you? What's your favorite part of the show?
My favorite part of the show is, after talking about this, we see a lot of negative impact, a lot of negative stuff impacting our economy. We see a lot of people not being able to make a quick decision. And why? Is just because it's too hard. Yeah. Right? But the good thing is, we talked about the HELOC, the home equity line of credit, and we see the positive side of things. So not everything's a doom and gloom, it's just how we utilize and leverage our current situation. So that's my favorite part is, everything's not as bad as we think.
That's right. So my favorite part is along the same lines. I mean, homeowners are in a much more advantageous position than they probably have ever been. And I'm going to say it this way, from data. Number one, you probably have a mortgage rate that is lower than you've ever had in your life as a homeowner. Part one. Part two, your equity is probably higher than it ever has been. Part two. And part three, you still have a way to leverage the remaining part of your equity to do something else.
Did great, Andy. Thank you.
All right. Well, thank you guys again for being on the show, and thank you for watching and tuning in. Remember, if you're watching us on YouTube, remember to not only follow the channel, but subscribe to the channel, like the video, and then turn on notifications so you catch every episode. And for those of you listening on Google and Apple, make sure you turn on direct download so that every time we release a new episode, you hear it first. Thank you guys for watching, and we really sincerely appreciate you. We'll see you again next week.
Peace.
Peace, and please give us your feedback.